The decline of well over 10% in January. Kenya's NSE was the worst performing stock exchange in the world. Bank stocks have borne the brunt of that decline, with 7 of the 11 failing by between 10% and 17%. However, after 52 weeks of losses, surely bank stocks have bottomed out. Well, that's a question CGTN's Ramah Nyang put to Ali Khan Satchu of Rich Management.
I think we had a blow-off bottom. A blow-off bottom is when everyone gets purged out of the system, and I think we saw that, and that's why we saw that red ink. We saw that very, very brutal price performance, and I think it was washing out everybody. And I think we saw a massive overshooting in the bank stocks. Some of these valuations are ridiculous. You know, Barclays Bank, I know it's got issues around the PLC, etc., but this is a 100-year-old franchise in Africa. It's going strong. You know, that's trading on a price-earnings ratio of 4. So I think what we have seen probably in late January was a bottoming out. We've had a little rebound. Let's see how that develops. But the issue for the banking stocks remains, you know, the interest rate bill, the need to reinvent themselves with these different models, and the fact that the bill, if you look at the political horizon, you can see there's no way this thing gets repealed before the election. No. Then you're talking about it sort of being repealed after the election. This new normal is...
And that's a pretty big if.
If, yeah.
Yeah, that's a pretty big
And I think the interesting thing about that actually is a global issue. You've got this populist style policy making and the unwinding of it. You know, people to recognize it's a mistake, then to do something about it is going to take very, very long.
And by then there'll be a lot of damage done. You know, lots of bodies on the floor, so to speak.
So to speak, investors have said, I don't want to be that body. It's better off, you know, having a little injury and taking my hit, yeah.
Right, but a lot of these guys are being hit particularly hard. NIC Bank, your DTBs, the small caps really are the ones who are taking an absolute hit on this. So let's say 2018 comes along, we're sitting here in February 2018, we're having this conversation. We're not going to have all these banks still in existence, are we?
Yes, this is the whole issue around consolidation. I mean, for a long time, I think there were various attempts to legislate it by raising capital levels. They were repelled, whether in Parliament. What has effectively happened is we're having market-led consolidation light with some help from the central bank. So essentially, I don't imagine we're going to have this number of banks. One expects an orderly transition as new investors come in. But you're completely correct. It's a Darwinian moment. We're going to have fewer banks. The fittest will survive, and that's a fact. And how that plays out will be dependent on the regulator and on the markets.
Right. The new rules also coming in for banks in April, I believe, which essentially now change how much capital they have to hold based on how much risk-weighted assets they're actually having on their books as well. Between that and of course the wave of bad news that will inevitably come in for the first quarter results, I mean, it is arguable that these prices could dive even further down, isn't it?
I would like to think that we've seen the lows for the year, but I mean, you know, I think in certain specific areas, obviously, you know, performance will be weaker than the market might have expected, and we might have some reactions. But I think what we're going to see is the winners are going to start winning. They're not too difficult to work out. The Standard Chartered, those banks where there's been a flight to quality, where people are now more interested in getting their money back than earning the interest component post those various issues we've had. And I think what you're going to see is that sort of bifurcation.